Best guess is 25, but I think there's a case to be made for 50 based on a little bit more softening of the labor market. I think we'll see. I think the percentage chance was in the low 30s.
That was Goldman Sachs CEO David Solomon on what to expect from next week's Fed decision. But our next guest has been calling for fewer rate cuts than the market expects. And joining us now is Torsten Slok, chief economist at Apollo Global Management. Torsten, welcome. Does this CPI number, both the core and overall, still support your outlook on cuts?
Absolutely. It confirms that the problem is that inflation is not coming down as quickly as the market has been expecting. So we also think that we will have a 25 basis points cut next week. And the general issue for the economy is that if you think about the dual mandate for the Federal Reserve, which is inflation at 2%, we're not quite there yet. We're moving in the right direction. The data today was not as good as we had hoped for, but still, it's still a decent move where inflation has come down to now today in the data, 2.5%. Likewise, the other part of the dual mandate, when it comes to growth, things are actually a lot better than what the market is seeing and expecting at the moment. You're seeing the Atlanta Fed GDP now is 2.5. The Dallas Fed weekly model for GDP is 2.4. None of that is a recession. None of that on the growth side is justifying a lot of Fed cuts. So that's why, John, to your question, we think that they will have plenty of time to lower interest rates, and that's why a 25 basis point cut next week should be more than enough.
Torsten, I think you told us last month that the talk about a consumer crashing was completely misguided, but banks were jumpy earlier this week, including Ally Financial, on some credit concerns. Are you not concerned about consumer credit at the low end?
Yeah, I know. Absolutely. Low-income households are experiencing more distress as a result of interest rates still being at elevated levels. But if you look at the incoming data, for example, the OpenTable daily data for how many people go to restaurants, that's as of yesterday still very strong. If you look at the daily data for how many people fly in airplanes from TSA, that's also strong. If you look at the Redbook same-store retail sales, so this is Redbook going out and asking Walmart, Target, Dick's Sporting Goods, they are still saying that, broadly speaking, the consumer is actually doing just fine. So you're right. There are some issues, in particular for low-income households, but high-income households, they have seen stock prices go up, home prices go up, and the cash flow you get in fixed income, in credit, including in private credit, has basically never been better in decades. So the support to high-income households or middle-income households from asset prices going up and cash flow from bonds continues to give us incoming data that is still very strong and not showing signs of a recession.
So, Torsten, the fact that you're making the argument that inflation is not in the rearview mirror here, and to your point, look no further than core CPI, which actually was a little bit hotter month on month, and not just from shelter prices, but airline fares moving higher for the first time after 5 months of declines, and a slower pace of deflation in used vehicles. What are the key areas that you're watching to have a sense on whether we're stalling out here in the disinflation narrative?
No, you're absolutely right, Morgan, and that's why the issue really here is to watch what's going on throughout the earnings season in different industries. And exactly as you're highlighting, the airline industry, they did several of the earnings calls from airlines. They did mention that there are some issues in economy in terms of the challenges, again, from lower income households. When it comes to premium cabins, across the board, the message was very strong that there's strong demand. Things are still moving along quite nicely. So the parts of the CPI we're looking at are, of course, those things that are most directly related to consumer spending. And of course, the thing that also got a lot of attention this morning and still is a very important topic is also housing inflation. So taken together, this whole narrative of a recession is here or a recession is coming, it is completely misguided. The incoming data, again, if you look at the GDP now from the Atlanta Fed and again their own Dallas Fed weekly indicator, the data is just not slowing down with that pace. So therefore, there is no need for the Fed to lower interest rates. And if the Fed still decides to lower interest rates, that just means that we should get even a bigger boost to the economy. So that's why the bottom line in our view is that things are just fine and the market is just getting carried away with all these rate cuts that are still priced in today.